Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, it's a special second ETF IQ this week.
I know. Is it Monday? Is it Wednesday?
No one knows. Let's get to the biggest stories right now in the more than $14 trillion global ETF industry. We start with fresh inflation data out this morning, showing that the Fed might be cautious with rate cuts as we head into 2025.
And in just moments, we speak to world-renowned economist Nouriel Roubini and Atlas Capital CEO Reza Bunday on their new Treasury Alternative ETF, given the risks they see in the upcoming Trump administration.
And as President-elect Donald Trump announces the threat of tariffs on his first day in office, we'll take a look at how Trump trades in the markets are impacting the flows. And as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now, but we're doing something different. We're starting with the drill down. Eric, what do we got?
We are. I'm going to have to get used to this. A little different today. So, Katie, Scarlett, thank you so much. We are drilling down into USAF, which is the Atlas America Fund. The best way to describe this would be like an asset allocation ETF. It invests in other ETFs and other asset classes. It's sort of like a real asset portfolio that an institution would use, designed to fight inflation or hedge inflation and make you through several kind of economic cycles, a durable portfolio, if you will. It just came out. It's a newborn fund, made a big splash because of Rubini being attached to it, one of many big names that have come into the ETF industry lately. It's 75 basis points is the fee. And let's look at the holdings here. So if you look, you're going to see a bunch of ETFs. And I got to give credit. Whoever picked these ETFs is a good ETF shopper, because IUAM is better than IAU because it's a cheaper gold. And some of these Treasury ETFs, again, very specific. This is a single Treasury ETF in U2, SHI. PDBA is a commodity ETF that has no K1, which is an annoying tax form. So somebody really kind of sifted through the ETFs and I think picked probably the best ones for this portfolio. But then for the REITs, which is income real estate, they pick individual stocks, which we'll go over in a minute. So let's look at the actual portfolio of the portfolio breakdown of the ETF, just to give you an idea of what you're buying if you get this ETF. 50% of it is treasuries, okay? Then you're going to get gold here, 17%, REITs, TIPS, agricultural commodities, and alternative strategies. So again, a lot like an institutional portfolio, Katie and Scarlett, and with Rubini's name attached, I'm sure this thing will get some looks.
All right, Eric, thank you. And let's keep the conversation going now with Nouriel Roubini. He is the CEO of Rubini Macro Associates, and we're also joined by Atlas Capital Team CEO Reza Bunday, who, of course, just launched this fund that we're talking about. Atlas, of course, is a fintech company that Rubini co-founded. It's great to have the both of you with us. And Nouriel, I want to start with you, since you are a first-time ETF issuer. And something we like to ask the debuts in the ETF industry is why now? What brought you to this wrapper now when it comes to why implement your strategy here?
Well, why now is because we live in a world where after COVID, the risk of stagflationary shocks that lead to higher inflation and lower economic growth are becoming more severe. And these types of stagflationary problems are going to be more serious during a Trump administration. If you think about the impact of tariff protectionism and trade wars, the impact of restriction to migration on the supply of labor, deficits and tax cuts that are unfunded, attempt to weaken the dollar, attempt to interfere with the Fed, getting out of the Paris Accord and worsening global climate change, all these factors, economic theory would suggest they would lead to higher inflation, lower economic growth, and therefore traditional safe assets that hedge against those risks, like long duration fixed income, don't do well in that type of environment. So you need a different type of asset allocation to hedge yourself against a variety of economic risk, inflation, the basement of fiat currency, de-dollarization, geopolitical and environmental risks.
Thank you for answering that. Clearly, it's tied to your economic outlook, and we can dig into that a little bit later on. But Reza, I want to bring you into the conversation as well. Why the ETF wrapper? Why is that the best format for really articulating this view?
Well, the origin of the Atlas program was out of the national security landscape back in 2017, when we were evaluating some of the risks that were kind of upcoming, in our view, geopolitical risks, climate risks, asymmetric risks, sociopolitical risks. And we felt that it was necessary to build a more resilient U.S. Treasury alternative. And the Trump administration actually came up with an idea of a gold-backed Treasury instrument, which we took upon ourselves to commercialize because the Treasury Department couldn't do so themselves. It would cannibalize their existing market, and they didn't have enough gold to really create much of an issuance. So the origin of this story came about by trying to create that Treasury alternative that could withstand the risks that we were forecasting. And so therefore, we thought the ETF wrapper would be the best solution, especially because we dynamically allocate these assets as we see market signals coming in, whether growth or inflation risks. So the ETF was just an ideal, liquid, and very well regulated and well structured instrument.
All right, Nouriel, this is a question for you. We talk about inflation, right? In 2022, inflation went up, Fed raised rates, and that caused treasuries to go down, right? A lot of bonds went down with stocks that year. The 60 and the 40 both fell. You have 50% treasuries in here, and I did notice a triple leverage bear ETF in there. Can you talk about managing that kind of a situation where inflation causes rates to go up, bonds to go down? How do you protect this treasury exposure?
Point is that we are going away in our portfolio from long duration fixed income and treasuries, because as you pointed out, when there are economic shocks that are inflationary, long bond yields go higher, the price falls, but also equity prices like 2022 go down. So the traditional safe asset is long duration treasuries doesn't work in a situation in which inflation is rising. That's why in our portfolio of treasury, we stay completely away from long-term treasuries, and all our allocation of treasury is short-term treasuries and tips that actually do well in times where inflation is higher and you have those types of economic shocks. So the point is the traditional safe asset that is negatively correlated with equities in a 60-40 allocation doesn't do well in a world of higher inflation, like we saw in 2022, 23, even this year. Therefore, you need an alternative. An alternative combines things that do well when inflation is higher. Short-term treasury, tips, gold, commodities, and environmentally sustainable REITs.
Nouriel, that's really interesting. And just to draw a bow on that point, it sounds like you're positioned basically for a curve steepener, that you have all this exposure to the short end of the Treasury curve, but positioned for the long end yields to go higher.
Yeah, in our view of the world, over time, all the inflationary shock that I described before implied that long bond yields are going to be higher, both in nominal terms and in real terms, as we're going to have tariff, migration restriction, independence of the Fed challenged, and budget deficits that run away. Therefore, the traditional safe asset doesn't do well. You know, in 2022, bond yields went from 1% to 3.5%, and 10-year Treasury lost more than S&P. S&P fell 15%, while 10-year Treasury lost price by 20%. So in a world in which average inflation might be 5% rather than 2%, bond yields may be closer to 7-8% rather than the current 4+. And therefore, $20 trillion of treasuries that the traditional safe asset will subject to massive price risk, 30-40% losses. That's the kind of world we're thinking. Not high inflation, not hyperinflation, but even a rise in inflation from 2 to 5, 6 has a massive damaging effect for the traditional long duration fixed income asset.
So this will be an actively managed fund. Nouriel, how often do you anticipate making changes to their portfolio?
Not very often. This takes a long-term view that actually forces that's stagflationary. So first of all, is in partly a quantitative approach. We look at states of the world in terms of growth and inflation and determines allocation. There's an element of it that is slightly discretionary, but we think about optimizing maybe once a month, not more often than that.
This is a question for Reza. When you think about the stock market, it seems like Trump wants stocks up. He brags about the stock market a lot. And if they go down, you think he would just bend over backwards to make stocks go back up. In your opinion, do you see that not happening this second term, or do you think that this ETF is needed just in case the stock market, kind of goes its own direction?
Well, there's a tremendous amount of risks offshore that we need to look at. this Lebanon-Israeli, for example, truce agreement may just create more risk against a war against the Iranians and the Israelis, which obviously has effects on the oil supply that comes out of the Persian Gulf. These kind of risks do significantly impact the stock market, especially as that oil goes to China, and there's obviously some other risks associated with the South China Sea. And so we don't see these events being positive for the stock market, and we see this instrument, and this instrument is designed to do so, doing well at times such as this. That's why we launched it at this time frame.
And Reza, I have another question for you. I thought an interesting detail was that this ETF was launched through Goldman Sachs ETF Accelerator Program. It's not quite a white label, but for those listening who maybe aren't familiar with the concept, basically Goldman Sachs helped you do the back office stuff, as I believe it, or understand it, to get this ETF to the masses. Can you talk us through why you went with that setup, for example, rather than hiring out an ETF team?
Yeah, in 2018, when we came off the back end of working through the alternative treasury instrument idea through the Trump administration and the national security think tank we were working through, the Goldman Sachs team took it upon themselves to help us devise this program as a more resilient U.S. Treasury instrument. They built an index initially. We built an annuity with them. And we just felt their team was really strong. They're really focused on national security. They're focused on resiliency. They've got a very strong relationship with Washington. And they've got a fantastic team at the ETF Accelerator. Lisa Mantle, Steve Sachs. These are really, really strong teams that we rely on to execute these trades. And we think that there's more work to be done underneath the illiquid portion of this ETF at a time and a place when the scale allows it. So the platform is very strong, but also the connectivity to the other parts of Goldman and their natural inclination to be more focused on national security and resiliency and economic security matters made them a natural choice. We're very proud to be working with them.
And Nouriel, when you think about this ETF, the big market for ETFs is advisors. Financial advisors are like 70% of ETF users. What does this replace for a typical 60-40 advisor? Is this going into the bond portion or the equity or maybe some other alternative portion they might have?
No, it's a substitute for the bond portion because, as I pointed out, the traditional defensive asset is long-term treasury doesn't work in a world in which inflation is going to be gradually higher, bond yields are going to be higher, prices are going to be lower for those bonds at the time where there could be correction in equity markets. The whole point of 60-40 is based on a negative correlation between bond prices and equity prices. Risk on growth, equity do well, bond prices fall. Risk off recession, bond prices go higher, the yield goes down, equities do worse. But that works only if inflation is low and stable. Instead, in a world in which gradual inflation goes higher, you lose on the equity portion of your portfolio, and you lose also on the bond portion of your portfolio. So when you lose on the bond portion of your portfolio, you want to have an asset that is actually truly defensive when interest rates are higher, because either there is higher inflation or bigger deficit than that. And so it's an alternative to the bond part of your portfolio, the defensive part of your portfolio.
All right, great conversation, you guys. Atlas CEO Reza Bunday, really appreciate you taking the time. Nouriel, don't go anywhere. You're sticking with us. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu. We're back with Nouriel Roubini. He is chairman and CEO of Rubini Macro Associates. And Nouriel, we're talking about this ETF that you have launched, which is a way to kind of guard against some of the economic outlook problems that you foresee given the new government that we're going to have starting next year. You mentioned stagflation earlier and how you are worried about that scenario. Based on what you've heard from the president-elect so far when it comes to cabinet picks, initial tariff threats, can you quantify the risk of stagflation over the next 4 years? Are we talking about 20% odds? Are we talking about 70% odds?
Well, some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accords is going to make climate change much worse, increase food prices and things of that sort. So if you look at this list of policies and others, all of them have the impact that over time, inflation will be higher, growth is going to be lower. That's a standard analysis of what's going to be the implication of this policy. So we have to worry about the world in which overall over the next few years, inflation is going to be gradually higher, economic growth could be lower. And therefore, you have to find a hedge against a world in which bond yields on the long side may be much higher than 4%. They might go towards 6, 7, even 8% in a scenario where inflation goes from 2 through 3, 4, 5. So that's the kind of concerns I have and the kind of tail risk. Inflation, debasement of fiat currency, potential de-dollarization, debts become unsustainable, climate change, geopolitical risks that fragment the world and lead to less growth and more inflation. Those are the kind of things we start to have to worry about and hedge against.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's TIPS, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis. Some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for lots of reasons about cryptocurrencies and Bitcoin because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
It's really interesting to hear those comments because, I mean, as Eric pointed out, some of the things you're saying really resonate with a lot of the crypto community, but it sounds like that volatility is just keeping you away here. But, I mean, the argument can be made that you take a look at gold, and it's not exactly a reliable hedge of inflation. I mean, it goes back and forth over the past 4 years. I know we're close to record highs right now, but when it comes to a stable store of value, are you sure that you found it in gold?
Well, gold has the benefit that has a variety of hedging characteristics. Usually, when inflation is higher, it does well. When there is a risk of debasement of fiat currency, it does well. In a world in which central banks are moving away from the dollar asset because of the dollarization, because we've weaponized the dollar for national security and foreign policy reasons, gold goes higher. Part of the reason why gold has gone higher 40% this year is because central banks of our rival are diversifying away. When there's a financial crisis and your money is not even safe in a bank, gold does well. So it's not a perfect asset, can go up and down. It's one element of a portfolio where you're hedging against a variety of tail risks. And from that point of view, is a better store of value than cryptocurrencies that are based on nothing. they're vaporware.
All right, Nouriel Roubini, always with the sharp insights. Nouriel Roubini of Rubini Macro Associates, thank you so much for joining us today. Still ahead, we're going to take a look at why Wall Street bull Tom Lee is betting big on ETFs, including his own. That's next, and this is Bloomberg.
This is Bloomberg ETF IQ. I'm Katie Greifel, along with Scarlett Fu and Eric Balchunas. It's a very special edition of ETF IQ on a Wednesday. We were just talking to Nouriel Roubini, of course, who just launched his own ETF, his debut ETF. Tom Lee of Fundstrat also has found his way into the wrapper.
Yeah, it's interesting. A kind of a bearish point of view, and then the Super Bowl, Tom Lee. And they both launched around the same time. It was it just felt right, I guess.
I forgot to ask what a granny shot.
Oh, a granny shot. Okay, so in basketball, they used to shoot free throws under their legs. Rick Barry was the famous one. And studies have shown you actually shoot a higher percentage of free throws, but the NBA guys will not do it because it just looks kind of lame. So it's interesting. He's taking what works in basketball and applying it here. And some of the stocks you may know, Tesla's in here, Netflix, but there's only 37 companies.
Wow.
So this is a highly concentrated, sort of like best ideas of Tom Lee ETF. And it's got 430 million, which is phenomenal for a couple weeks.
So he calls it an unconventional pick, I guess, for an unconventional basketball free throw style that he likes. And by the way, the name of the ETF is the Granny Shots U.S. Large Cap ETF. So that's why.
That was important context that I should have put in there.
Well, because we're a little bewildered as to why Granny Shot. Not everyone understands that reference.
Well, it got you thinking, right? There's 400 U.S. large cap equity ETFs, and there's like another 1,000 mutual funds. There's just so much, it's crowded over there. So to come up with another way to phrase it, and it's something that matches with your style, plus you have Tom Lee, who has a following, that's a good combination to kind of stand out from the crowd. And that's half the battle with ETFs. You got to break through the clutter, and this is a very crowded category.
Yeah, and it's really interesting. I mean, it's part of the trend that these active portfolios are becoming more concentrated. It's definitely one of the stories of 2024. But I think we have to say goodbye now to our special edition of ETF IQ. You can read all about the industry, though, when you subscribe to our weekly ETF IQ newsletter. That's Bloomberg.com/newsletters. That does it for now. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas. Have a great Thanksgiving. This is Bloomberg.